Okay, so I'm a very simple person, so what I'm going to do is start with some definitions, and then I'm going to show you one reason why we shouldn't panic during a stock market decline. So in terms of definitions, a pullback is very common. It happens about 3 times a year, and it's about a 5% decline in the stock market. And then you've got corrections which are slightly larger, so 10% plus decline lasting days to months, and it happens every 1.5 years or so. And then you've got the bear market, which is a 20% plus decline lasting months to years, and it happens every 3 to 4 years or so. So with the definitions out of the way, I want to explain to you why we should not panic sell during stock market declines. And I'm not going to talk to you about Buffett indicators, yield curves, market sentiment, or even inflation. I want to keep it very simple and show you some trends. More specifically, I'm going to show you the S&P 500. So the S&P 500 is basically a collection of the 500 largest companies in America, and it is the best indicator of how the stock market is performing on average at any particular time. So if we look at the over the past 5 years for the S&P 500, you can see that generally we had an uptrend, and this is why it's important to follow trends. If you have a look here in 2020, this was the Corona crash where we had a 30% plus decline, and a lot of people actually sold during this low because they were worried that because the stock's dropping, it's going to keep dropping. But as I said, if we followed the trend, you know that it's going to recover. And with the benefit of hindsight, you can see that the S&P 500 since the all-time low is now, or not, sorry, not the all-time low, since the COVID low has actually hit an all-time high. Okay, and that's just one example. If we have a look at the past 70 years or so, you can see that we've had many stock market declines, and after each decline, you can see that we've recovered and reached all-time highs after that. And again, you can see that the trend is very clear. It's definitely an uptrend despite the short-term volatilities. So it's quite useless trying to time the market and buy during the lows, sell during the highs, because ultimately the easiest thing to do is just to buy the market and then just hold for the long term. And if you thought that that was only in the last 70 years, I can show you even further back. Again, you can see the trend. You can see the trend is upwards. Look at the Great Depression. We had an 85% decline, and after that you can see we actually continued our rallies, reached all-time highs in a matter of, well, actually this took a bit longer, but at the ultimately we ended up reaching all-time highs. Some of the more notable ones in the recent years is the global financial crisis in 2008. And then you've got the dot-com bubble in 2000, and then you've also got Black Monday crash in around 1989. And you can see that since all of these lows, we've managed to destroy the actual lows that we hit during these crashes. So, and if you look here, 3,000 for the S&P price, we're above 4,000 now, we're 4,200. So like I said, not talking about Buffett indicators, yield curves, inflation. It's very simple. Look at the trend over the past actual 100 years, more than 100 years. Over the past 150 years, you can see that we are in an uptrend and it's going to continue. The reason for that is, if you imagine you had cash, leaving it in cash is not only bad, not only just keeping the money as it is, you're actually declining the value of your assets, because people are printing money and inflation is happening. So if you invest in a company, the actual company is making you money. So that's just a simple rule. Anyway, thank you so much for watching, and I'll see you in the next one.